This is a satisfying kind of math. 1 barrel of oil, 42 gallons, roughly $75 on the global market right now. You could fill your car's tank about 2.5 times with it. Seems simple enough. But here's what's strange. That same barrel, if it comes from a specific region of southwestern Iran, a geological formation called the Azadegan Field, is worth something entirely different to the people making decisions in Washington. Not $75, not $150. To them, that barrel represents control over 500 billion barrels sitting beneath the sand. And 500 billion times $75 is $37.5 trillion. That's not a number that fits on a balance sheet. That's a number that rewrites the global order. 3 weeks ago, American forces crossed into Iranian territory. The official explanation involved nuclear facilities, terrorist networks, imminent threats, the usual vocabulary. But if you've been watching the energy markets, really watching them, not the headlines, but the contract flows, the strategic reserve movements, the quiet meetings between Treasury officials and oil executives, you already know this isn't about nuclear weapons. It never was. This is about the largest untapped oil reserve on the planet. And more importantly, it's about who gets to price it, who gets to sell it, and what currency it gets sold in. Here's what they're not telling you. On January 3, 2026, at 6:15 a.m. Eastern, the National Iranian Oil Company finalized an agreement with PetroChina and Gazprom Neft to develop the Azadegan and Yadavaran fields, a combined estimated reserve of 500 billion barrels, entirely outside the dollar system. No SWIFT transactions, no New York clearing, no American banks touching a single cent. The deal was structured in yuan and rubles, with settlement through the Shanghai Petroleum and Natural Gas Exchange. By January 4th, the first futures contracts were trading. By January 5th, the Pentagon had received updated intelligence assessments. By January 12th, American soldiers were on Iranian soil. The official story is regime change and regional stability, but the data shows something far more mechanical. What we're witnessing isn't a war for democracy. It's a war for the pricing mechanism of the world's most critical commodity. To understand why this matters, you need to understand how the petrodollar system actually works. Not the theory, the plumbing. Since 1974, virtually every barrel of oil sold on the global market has been priced in US dollars. This isn't because dollars are inherently superior. It's because of an agreement, never publicly signed, never officially acknowledged, between the United States and Saudi Arabia. The Saudis would price their oil exclusively in dollars and recycle their surplus into U.S. Treasury bonds. In exchange, America would guarantee the security of the Saudi regime. This arrangement created something unprecedented: artificial global demand for dollars. Every country that needed oil, which is every country, needed dollars first. They had to earn them through exports to America, or borrow them from American banks, or buy them on foreign exchange markets. This constant structural demand allowed the United States to run deficits that would bankrupt any other nation. It allowed the Federal Reserve to print currency without triggering the inflation that would normally follow. The petrodollar isn't just a financial arrangement. It's the foundation of American hegemony. And Iran just tried to build a door around it. The Azadegan field alone changes the math of global energy. Discovered in 1999, it sits in Khuzestan province near the Iraqi border. Initial estimates put reserves at 37 billion barrels. But geological surveys conducted by Chinese firms between 2019 and 2024 revealed something far larger. The formation extends deeper and wider than anyone realized. The revised estimate, 500 billion barrels of recoverable crude, would make it the largest oil deposit ever discovered. Larger than Saudi Arabia's Ghawar field, larger than Venezuela's Orinoco belt. For context, the entire proven reserves of the United States total approximately 44 billion barrels. Iran is sitting on more than 10 times that amount in a single formation. But here's where it gets dangerous. This oil was never supposed to reach the market, at least not outside Western control. American sanctions, in place since 1979 and intensified dramatically since 2018, were designed specifically to prevent Iran from developing these reserves. Without access to Western technology, Western financing, and Western markets, the oil would stay in the ground. Iran would remain a mid-tier producer, unable to challenge the existing order. China changed that calculation. Between 2020 and 2025, Chinese state-owned enterprises invested over $280 billion in Iranian energy infrastructure. They brought drilling technology. They brought pipeline expertise. They brought something even more valuable: a buyer who didn't care about American sanctions. The January 3rd agreement wasn't the beginning of this relationship. It was the culmination. China and Russia weren't just buying Iranian oil. They were building an entirely parallel system, one where American financial weapons couldn't reach. This is where the lie becomes unsustainable. The United States maintains the petrodollar through two mechanisms: economic incentives and military force. Countries that price oil in dollars get access to the American financial system, American markets, American security guarantees. Countries that try to price oil in other currencies get invaded. This isn't conspiracy theory, it's documented history. In 2000, Saddam Hussein announced that Iraq would begin pricing its oil in euros instead of dollars. By 2003, American tanks were in Baghdad. In 2010, Muammar Gaddafi proposed a gold-backed African currency for oil transactions. By 2011, NATO aircraft were bombing Tripoli. The pattern is so consistent it barely requires analysis. Iran understood this history. They watched Iraq. They watched Libya. They knew that any attempt to bypass the dollar would trigger an American response. So they spent 15 years preparing. They built relationships with China. They integrated their military with Russian systems. They developed domestic missile capabilities that could threaten American bases throughout the Middle East. They calculated, correctly, that the cost of invasion would be high enough to deter it. What they miscalculated was how desperate Washington had become. Here's the mechanism that explains the timing. The Federal Reserve has a problem. Since 2020, the U.S. national debt has grown from $23 trillion to $41 trillion. Interest payments alone now exceed $1.2 trillion annually, larger than the entire defense budget. The only way to service this debt without triggering a currency crisis is to maintain global demand for dollars. And the only way to maintain that demand is to ensure that oil, the one commodity every nation needs, continues trading in dollars. The January 3rd agreement threatened to unravel this entire structure. If Iran successfully sold 500 billion barrels outside the dollar system, other producers would follow. Saudi Arabia, already hedging with yuan-denominated contracts, would accelerate its diversification. The UAE, Qatar, Kuwait, all of them are watching. The moment one major producer fully exits the dollar, the game theory changes for everyone. This isn't about Iran. It's about preventing the first domino from falling. When institutions do what the Pentagon did on January 12th, they're not managing risk, they're containing disaster. The speed of the operation reveals the desperation behind it. Less than 9 days from the signing of the agreement to boots on the ground. No UN authorization, no congressional declaration, no coalition building, just immediate, unilateral action. The military objectives tell the same story. American forces didn't target nuclear facilities first. They targeted oil infrastructure. The Azadagan field, the Yadavaran field, the pipeline connections to the Chinese-built terminal at Jask. Within 72 hours, every piece of equipment that could have enabled yuan-denominated oil exports was either destroyed or under American control. The last time the United States moved this quickly was March 2003, when the real target wasn't weapons of mass destruction, but the Central Bank of Iraq and its euro-denominated oil accounts. At 2:30 a.m. Eastern on January 14th, the Treasury Department issued Emergency Directive 2026-1, authorizing the seizure of any Iranian assets that had transited through the yuan-based settlement system. By 4 a.m., the Federal Reserve had activated swap lines with the European Central Bank and Bank of Japan, flooding the market with dollar liquidity to prevent any contagion from the Iranian banking collapse. By market open, crude oil futures on the NYMEX had spiked 23%, while the yuan-denominated contracts on the Shanghai Exchange had been suspended indefinitely. This is what a system looks like when it's defending itself. While one side prints, the other side takes possession. And this is where the story becomes something larger than Iran. China's response to the invasion has been remarkably restrained in public. No military confrontation, no dramatic sanctions, just quiet, systematic acceleration of everything they were already doing. In the 2 weeks since American forces entered Iran, the People's Bank of China has purchased 89 metric tons of gold, the largest monthly acquisition in their history. Russia has announced that all energy exports to China will now settle exclusively in yuan and rubles. India, trying to stay neutral, has nonetheless increased its own gold reserves by 34 tons. The pattern is unmistakable. Every nation watching this conflict is drawing the same conclusion. The dollar system is no longer a safe harbor. It's a weapon. And any country that holds too many dollars, that depends too heavily on American financial infrastructure, is vulnerable to having those assets frozen, seized, or devalued the moment Washington decides they've become inconvenient. This is not about who wins the war in Iran. It's about who controls settlement in the world that comes after. The BRICS nations, Brazil, Russia, India, China, South Africa, and now including Iran, Saudi Arabia, Egypt, and the UAE, have been building alternative financial infrastructure for years. The cross-border interbank payment system, China's alternative to SWIFT, now processes over $12 trillion annually. The new development bank has $100 billion in authorized capital. The proposed BRICS currency unit, backed by a basket of commodities including gold, has moved from theoretical discussion to active development. The invasion of Iran didn't stop this process. It accelerated it. Every bomb that falls on Iranian oil infrastructure is an advertisement for de-dollarization. Every frozen asset is proof that the dollar system requires political obedience, not just economic participation. This is the trap that Washington built for itself. Defend the petrodollar with military force, and you prove to the world that the petrodollar requires military force. Prove that it requires military force, and you accelerate the search for alternatives. Accelerate the search for alternatives, and you guarantee the very outcome you were trying to prevent. There is no version of this that ends with American hegemony intact. There is only the question of whether the transition happens over decades or years. The math doesn't lie. The United States consumes roughly 20 million barrels of oil per day. It produces about 13 million domestically. That 7 million barrel gap has to come from somewhere. And increasingly, the nations that control that oil, the nations with reserves still measured in the hundreds of billions of barrels, are choosing to sell it to someone else. Iran's 500 billion barrels were supposed to stay off the market. Now, they'll simply flow east instead of west, priced in yuan instead of dollars, building Chinese leverage instead of American. The invasion didn't secure those barrels for America, it secured them for China, just with a longer timeline and a higher body count. Every institutional response now makes the underlying problem worse. Raise interest rates to defend the dollar, and you crash the treasury market that requires low rates to remain solvent. Print money to keep interest rates low, and you accelerate the inflation that makes dollar-denominated assets unattractive to foreign holders. Use military force to prevent oil from leaving the dollar system, and you prove that the dollar system is a protection racket rather than a market. There is no move that improves the position. There is only the choice of which failure mode to experience first. What the informed understand, the sovereign wealth funds, the central banks, the family offices managing generational capital, is that this moment requires a different kind of calculation. Not prediction about what prices will do, not speculation about military outcomes. Something more fundamental. The question is not whether the dollar remains the world's reserve currency. The question is what you're holding when it stops. Physical commodities don't require settlement through any particular system. Gold in a vault doesn't care whether SWIFT exists. Oil in a strategic reserve doesn't need the Federal Reserve's permission to have value. The nations accumulating these assets aren't making predictions about the future. They're removing themselves from a system that has begun to eat itself. This isn't investment advice. It's not a recommendation to buy or sell anything. It's simply an observation about what the largest pools of capital on the planet are doing, while the headlines focus on military operations and diplomatic statements. 500 billion barrels sat beneath Iranian sand for millions of years. They'll sit there for millions more, regardless of what flags fly above them. The atoms don't care about our currencies, our alliances, our theories about how the world should work. They simply exist, waiting to be claimed by whoever has the patience and the positioning to take delivery. The divergence between what we're told and what's actually happening isn't a failure of journalism. It's a feature of a system that requires its participants not to understand how it works. The moment enough people see the mechanism clearly, the petrodollar, the military enforcement, the inevitable mathematics of debt that can never be repaid, the mechanism stops working. That's why the real story is never the one they're telling. The real story is in the contract flows, the reserve accumulations, the quiet repositioning of capital from promises to possession. Reality has a way of asserting itself. It doesn't ask permission. It doesn't wait for consensus. It simply arrives, sometimes slowly, sometimes all at once, and rearranges everything we thought we knew about how the world works. 500 billion barrels, $37.5 trillion, and a system that just revealed exactly how far it will go to maintain control. The question is not if the structure changes. The question is, who understands what's happening while there's still time to understand it?